Hey, what's going on everyone? My name is Bo Crable. I'm the founder of Option Scout, and in this video I want to explain the 3 factors that make up the price of an option, and also I'm going to talk about factors that don't make up a price of an option but you should be aware of. And once you understand this, it's going to help make your trading strategies or how you're choosing to buy and sell options just much easier and to help you execute it. So the price of an option stems from this formula called the Black-Scholes formula. It's a bit complicated. If you want to learn about it, Khan Academy has a great lesson onto it. However, I'm not going to go into that, but I'm going to take this complicated formula and simplify it for you so you know the factors involved with it. All right, so with the Black-Scholes formula, the price of a call option or price of the put option, here are the main factors. Time, so this one's a little bit obvious that as time is further out in time, so if let's take a 160 strike price call option that expires in 1 week compared to one that expires in 1 year, the 1 year is going to be worth much more. And why is that? Well, the reason for that is because since there's more time, there is a higher probability that stock could go up or down much more. So that's why traders are willing to pay a higher price for it. The next thing is implied volatility. So implied volatility, just think of it as how dramatic is the stock going to go up and down. If you take a stock like Costco, for example, it's not going up and down too much every single day. It's pretty stable. You know, sometimes they'll have some dips here and there, but it's not very dramatic compared to, let's say, AMC stock or any type of meme stock, or even small cap stocks that can have much bigger movements. Those have a lower implied volatility. And as implied volatility is higher, then the price of options, either puts or calls, doesn't matter which one is going to be more expensive. And the reason for that is because it's just a more dramatic of a bet. And here's the thing that's good to understand is that this is not a free lunch situation. So like, oh, I'm going to be really smart and only sell high implied volatility options. Well, the issue with that is your probability is actually probably worse. Compared to selling options on low implied volatility. Now, it depends which premium you're collecting, your ROI, but think of this as real estate. You know, let's take, for example, real estate in Austin, Texas versus somewhere in the middle of nowhere. Austin, Texas have just been going up and down so much, and people are willing to pay a much more higher price for a house in Austin because of the fact that they know that in the future it could go up even higher. Compared to the middle of nowhere, no one's going to pay that much for it because it's like, okay, that's the price of materials. Like nothing's going crazy that's going to make it shoot up in price. That's implied volatility. So higher than implied volatility, higher it can go up or down, which again doesn't necessarily mean good or bad. And then the last thing, which is a bit obvious, is the stock price. So as the stock price increases, the absolute value of a call option increases. As the stock price decreases, the absolute value of a put option decreases. The last thing that I actually just now realized is also dividends. So if a stock has a dividend, that's going to play into the formula as well. So now that you understand these 3 things, let's talk about these. So let's talk about the stock price. Well, okay, it's black and white. If stock goes down, puts go up. Stock goes up, calls go up. But something to understand, like ask yourself a question. If the stock goes down a lot, massively corrects, do you think you have a higher chance of going back to the all-time high now since it's lower or before, right? So what I mean by that is, let's say you're looking to buy a call option and you think that the stock is going to go to, I don't know, 160 or something like that, and the stock goes from 155 down to 150. Well, if you're trading stocks that have a history of increasing in value, think for a second. Technically, you have a higher probability of the stock going up in value because it has had a history of going up in value. Like the S&P 500 has averaged a positive return year over year over year. It has not gone down. So and you could do this the opposite for inverse ETFs. And the reason why this is important is because nowhere in the math of option contracts are we pricing in that we're assuming the stock goes up. There is one thing that does factor in. It's about the risk-free rate of return. So the risk-free rate of return is like, think of it as the treasury yield on the 10-year treasury bills. Right now it's like 3.5%. So that is calculated in. So you got to understand that we are assuming that we're in a risk-free world, which is interesting because if you look at ETFs, they actually usually dramatically outbeat the risk-free rate of return. So that's something to understand. Implied volatility. This is interesting because if you look at earnings dates, implied volatility massively shoots up, and we can always we can pretty much assume that implied volatility will go down after earnings, which is a very interesting thing. A lot of traders say stay away from options during earnings, and the reason for it is that if you're selling options or if you're buying options, even if the stock goes up, you may be at a loss because implied volatility just sucks out that option price. But we can kind of assume that because of the fact that there's an earnings going on, because again, the Black-Scholes formula is not factoring in that Apple stock has an earnings on this date. It's just not at all. If it was factored in, if in a perfect world, it would. But here's an interesting thing. It's not, but we can assume that it's going to drop down. Another thing is if we see that there's like a shareholder that just sold a bunch of their stock. Well, we can factor in that's probably a negative sentiment for the stock. So that's a lot of things associated with it. And the only other thing, time is constant. So that's the one thing you can depend on with stocks, that the factor is that time is constant, but implied volatility and the stock price is not. But then if you take, again, there's no other factors to be time besides the day goes on, but implied volatility, it's like, okay, that is the value that's changing, but what can change that? Like, do you know that Tesla is having an AI day in 3 months from now? Or do we know that a certain change in the executives is happening? Like, that's obviously going to change implied volatility. So people kind of, I'm not saying to do this, but a lot of traders will play with that. They'll look at dates and be like, okay, people are not factoring this in. People are not factoring in that on this date, this is going to happen, Or, this is kind of obvious with a lot of crypto stocks, right? Like, there's a lot of events that happen in the Bitcoin markets and the crypto markets, and that can play into the implied volatility. And then if you can understand technical analysis, or you can understand fundamental analysis where you believe that the stock is undervalued, then that would make sense maybe to buy options, because of the fact, okay, you're doing a discounted cash flow analysis on a stock, and I was, oh my gosh, it's really undervalued. I think the stock is going to go up in the next, X amount of days. So anyhow, that's about it. I just want to explain that to you, and hopefully that helps you understand when you're making up your option trading strategies.